Implied volatility can quickly ruin an options trade by offsetting price moves in the underlying security or drastically increasing the extrinsic value in short options. Being on the wrong side of volatility hurts. Therefore, it's best to be on the right side or find ways to limit its effects. The risk profile tool on the Thinkorswim platform can show you how changes in volatility hurt some strategies, but help other strategies by modeling potential changes in volatility along with changes in time and the underlying asset's price. To get started, let's say we're interested in trading NVIDIA. That's just an example here, not a recommendation. So we'll take a look at the NVIDIA chart. This is a 1 year, 1 day chart going back to about June of last year. We can see here up until now. And we can see that NVIDIA has been pretty range bound. We can see that support looks to be around 170 of this range. It did briefly pop up to about 212 here, but the top of the range is around 194. So we're right in the middle right now at about 180. So to take advantage of NVIDIA being range bound, let's do a calendar spread today. It's kind of like a covered call, but as opposed to having 100 shares of the stock, we're going to buy an option that's a bit further out. Let's say we're going to go 60 to 120 days, and then we're going to be selling a shorter term option. So switching over to our Analyze tab and our simulated trades, let's say we go to May 15th, about 101 days out here, and our at the money call currently is a strike of 180. So let's simulate if we were going to be purchasing the 180 strike call for May 15th. And for our short-term expiration, let's go to February 20th, which is currently about 17 days out. And to make it a calendar, we're going to hold down Control on our keyboard, and we're going to left-click on the bid of the 180 call for us to sell it, which then creates that calendar spread, keeping our same strike of 180 with different expirations. And as we can see currently, this is a debit of $11.15. So let's switch over to our risk profile and take a look at this calendar. We can see here, this purple line is going to be referring to today's date, February 3rd, and our light blue line is referring to at expiration of our short leg, which is February 20th. So this line is representing February 21st. So ideally what we're looking for here, because we are long the further out month, an increase in implied volatility is going to be helping us, but we're generally going to want to be staying at the strike price of 180 for us to realize our max profit. So here we were looking at profit potential based on today's date versus our short leg expiring. Let's switch up this graph a little bit and take a look at how volatility changing is going to impact our trade. So we're going to go up to our line section and click here and go to vol step. And in this case, let's step 2 different times. So now what we're looking at, this is at the current volatility of about 51.38%. You can see here we're stepping 5%. So as volatility were to increase 5%, we see more profit, as well as if it was to increase 10%, we continue to see more profit. And so in this scenario, if volatility were to be increasing and helping our trade, maybe we change our game plan and decide to take some of that profit off of the table and move on to the next trade. So that's definitely something you want to keep in mind when you're making these trades. If they're working in your favor, you don't need to see them all the way through. You can decide to take your profit and move on to the next one. And so now to switch our risk profile back to how we originally were looking at it, let's go back up to our lines, go to our expiration, and +1 at expiration. That brings back our purple line, which is today's date, and our light blue line referring to expiration. And so now we're going to look at how volatility changing impacts this risk profile here. The more time involved, the greater the range that the stock can move, and thus the greater change in implied volatility. So let's take a mental note here on where we're at on the trade based on the current volatility, which has the volatility on our long leg at about 45.7% and our short leg at about 44.6%. Right now on this trade come expiration, we're up about $5,400. Let's say we now adjust the volatility and we increase the long leg 15% and increase our short-term leg about 5%. And we can see here That drastically increases our profit potential. Now we're up about $10,500 come expiration, as opposed to about $5,400 when volatility stayed the same. And this is at our strike price of 180, where we're going to see our max profit potential. So now let's take a look at the opposite effect. Let's drop our volatility from up 15% and up 5%. Now we're going to say we're going to be down 15% on our long leg, and we're down 5% on our short leg. And let's see how this affects things. So now come expiration, you can see this drastically change things. Now we're only up about $259 in profit, compared to about $5,400 in our base scenario come expiration. So now let's tie everything together along with the other factors involved with this trade. So we're going to take a look here. Right now it's February 3rd, and we're going to switch this to a week from now, and we'll look at February 10th. You could see that purple line moved a little bit. So now we're going to adjust the volatility on our long leg from positive 15%. And let's say volatility is decreasing as price is increasing. So we're going to drop our long leg down 5%. And let's say on our short leg, volatility decreases about 2%. And then if we go up here a little bit, we can see a gear where we can adjust the stock price. So let's say the stock goes up to 185. And we can see how our graph adjusts for that and our purple line. So in this case, if volatility is decreasing and the price is increasing further away from our strike price of 180, we can see that as of about a week from now on February 10th, we're down about $715 on this trade. But because time decay is also a factor that is helping us in this trade, on our short leg, then come expiration, we're still positive about $1,600, even though volatility is decreasing, which is hurting us. So now let's look at a few scenarios in regards to the way forward with this trade and our potential exit strategy. So as we get to February 20th, which is our expiration, we can decide if we would like to roll out this call. And if we're doing so, maybe we take a look at the strike prices and determine if the price has gone up a bit, if we want to change our strike. It might be a little risky if we're selling another in the money call. And so in that scenario, maybe we decide to raise our strike prices. And so that's our scenario if the stock is higher. What if the stock was to go down? So let's say now the stock, rather than going up to 185, the stock goes down to 175. And with the stock falling, let's say that implied volatility is increasing. So now let's say we increase volatility by about 5%. And for our short leg, we'll change it from the -2 to if it was increasing 2%. And we can see how that changes here, where based on a week from now, we're up about $1,800 now. And then come expiration, it's about $4,100. So in this case, in regards to our plan looking forward, our 180 strike call is out of the money, so it would expire worthless. So we can determine at that point if we want to sell another call and keep this trade going, or if we want to close out of the long leg and finally just take our profit. And because we're doing this with calls, at the end of the day, we are long a call, which is the base of this trade. And so as we can see here, as the stock is falling, even if implied volatility is rising, we start to see losses the further that we go down. And so that's what you can determine come expiration, depending on what the stock is doing, if you just want to close out of the trade, or you can change the current trade now that you no longer have the short leg, and we can change our strike prices if needed. Okay, so we've looked at the different scenarios if the stock was to go up or down. Let's just reset our risk profile tool here and put these values back to where they were. If the stock does remain range bound and we're selling this short leg here, as time goes on, we can see that purple line getting closer to that blue line as we collect that time premium, and we can continue to roll out this short call to keep bringing in premium as we go forward toward that long expiration. The risk profile tool allows you to model potential scenarios so you can better understand how your strategy may react to changes in implied volatility as well as price and time. Use the risk profile tool as part of your analysis when you determine whether to hold, close, or roll your options trade.